Welcome to the Market of the Moment, week of August 8th, 2022. Michael Oldham with Chris Madrid. What's up?
Hey, man. So good to be here. So good to be here.
Always good to be here on a Thursday. Well, let's move on to real estate. Today we're going to talk a little bit about how would housing be impacted by a recession, because with all the inflation talk we have been hearing about a recession, we know that's what follows inflation generally. And Chris and I have been talking the last several weeks about how generally it is brought on by our government and by the Fed and their what they charge for the use of money. So let's take a look at a few slides here. How would housing be impacted by this recession we hear is coming? Some people think it's already here. First, we'll define what a recession is. This is from the National Bureau of Economic Research, and they define a recession as a significant decline in economic activity spread across the economy, meaning in all different sectors, lasting more than a few months. Generally, it is 2 months in a row, I believe. Normally visible in our real GDP, or gross domestic product, which is what our country is producing, real income, employment, industrial production, and wholesale retail sales. So that is the definition of a recession. So when you hear the word, you need to know what it actually means. It's a significant decline in economic activity, meaning people aren't going out and spending as much as they were spending. Right. We are not producing as much as we once were producing. So that is what a recession is going to look like. What does that mean for home pricing? And I believe we've talked about this before in some of our other videos, but never going to miss the opportunity to talk about it again. But basically, this shows the home price change during the last 6 recessions, dating all the way back to the 1980s, which is known as one of the worst, I believe, recessions in our most recent history. And you can see home values still went up by 6.1% during that time of recession. In 81, 3.5%. In 1991, we did see a decline in home prices by 1.9%. I don't think that would probably be too huge of a hit to anybody, especially after you saw 10 years of probably 3.5% going up in between there. 2001, you saw a 6.6% increase in your home pricing during that recession. Only in 2008, which is known as the Great Recession, this is obviously the housing bubble, housing crash that everybody wants to, I feel like, go back to every time we talk about something. They want to compare it to it. And there's really no compare other recessions to what happened in 2008, because it was a different situation. So anyway, then you did have a major loss of value during that time period. But we've looked at other charts and it bounced back within a couple of years, I believe. Somebody dropped a comment on one of our YouTube videos that they nearly lost their house in 2008. Yeah, but managed to keep it. And now it's worth like 6 times what they had paid for it, or something like that.
Absolutely. So, yeah, for sure.
And then you can see during the pandemic recession, we still saw home value and home price rising during that time. What a recession does mean is falling mortgage rates. As you can see, mortgage rates in the last 6 recessions, from the peak to the trough, and what happened to them. So in 1980, 81, you have basically a 9.25 decrease in your interest rate. So what we go from 18 down to 8% or something, most likely in the 80s. Yeah. So in 91, we saw a decrease in the mortgage rate. 2001, a decrease. So all the way across, you see that when recessions have hit, mortgage rates have fallen. So if it is interest rates dropping that you're looking for, you are probably tickled, or you should be tickled, at hearing talk of a recession. So Mortgage
Absolutely.
rates and recessions, another chart we've looked at before. This is 30-year fixed rates. So as you can see, we have our recessions highlighted in yellow here, and you can see what the mortgage rates did prior to and leading into the recession. They are dramatically going up quickly, much like we've seen, over the last
This year.
month, this
Yeah.
year. And then, as you can see, at the pretty much peak of that recession, the interest rate drops significantly, almost like it's dropping off of a table. It doesn't tick down slowly. They drop. And then you can see, if you look at this chart from a historical view, you can see mortgage rates have dropped from that high 18, 19% in the 80s. It's been on a constant downtrend ever since, only kind of spiking back up, recently. So, and as Chris has talked about, we are most likely going to see this far right of this chart ticking back down toward that 3.75. We're probably not going to get there, but back to the fours as we start hearing this talk of recession, which we hear it all the time. You have anything to add to that, Chris?
No, it's spot on. I mean, you mentioned the 80 to 81, that 5% dip, and here it is. Clearly rates are at 18%. They dropped to 13%. So again, we're about the facts, man. We're about the data to support what we're talking about. So here it is. Here it is right here. So yeah, when I say that, hey, I fully expect rates to come down in the next, 8, 12, 14 months, it's not just, I'm not pulling it out of my hat. It's because of obviously the data trends that we're seeing here.
Based on the data. So over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact, as it takes some time to turn things around, even when the recession is technically over. And that comes from Fortune magazine. So, we're talking now, we're, kind of getting into this. So if we were to look at a 1.8 percentage, we'd probably be getting down into those high fours and kind of like where we're at right now. So all of these things kind of fall together, and it's all basically following, historical patterns.